right? It's being invested in plant-based companies is all about being on the right side of change, on the right side of innovation. However, before we dive into investing, something that's very critical before you start trading is actually have somewhat of a financial plan, or at least have a sense, as we want to cover your bases before talking about trading options. So for last section, there's no better person to walk us through than Justin. I'll hand it off to you, Justin.
Thank you, Henry, and thank you so much, John. That was great. And one thing that I forgot to mention a little bit about myself is prior to getting into the financial services industry in 2016, I actually came from a background where I had my own business as an entrepreneur, as a personal and group fitness trainer. And so I spent roughly about 8 years walking people through fitness and nutrition plans, building those out for people and helping them get from point A to point B, dependent on their unique situation and their goals. And so it was a natural transition for me to come into the financial services industry and do the same thing instead of a fitness and a nutrition plan, more of a money plan or a financial plan. And when I was running my fitness business, I found myself, I knew nothing about credit. I knew nothing about financial planning. And I found myself having a bad credit score, not having the proper savings, and all the things that a lot of people find themselves in. So I find it that I'm in a position now where I can at least just share stories and share my experience, not necessarily tell people what to do, but just share some stories and examples that might help them, that helped me. And so the first part of this slide is, what is a financial plan? So in general, a financial plan is a comprehensive evaluation of an individual's current pay and future financial state by using current known variables to predict future income, asset values, and most importantly, withdrawal plans. So why would somebody be interested about financial planning? And that is because financial planning is for everyone. It is not for those who have amassed massive amounts of wealth. Financial planning is truly for everyone. Financial planning is more than budgeting, saving, or the perfect investment strategy. It sets you on a course towards achieving your goals through the proper management of your financial affairs. It is said that Canadians who engage in financial planning report significantly higher levels of financial and emotional well-being as compared to those who don't. They say they feel more on track with their financial goals and retirement plans, have improved their ability to save, and are more confident that they can deal with life's challenges and feel better about indulging in vacations or other luxuries. And from the Canadian Financial Planning Council, it is said that 80%, again, 80% of those with comprehensive financial plans say that they feel on track with their financial affairs, versus only 44% that have no planning. So that's a little bit more about what a financial plan is and why you would want one. The statistics show that those Canadians who have an actual comprehensive financial plan not only feel better, but actually end up performing better as well. So still on the slide here, the 5 steps to financial planning success. This is widely known, again, by certified financial planners as the model that they follow. Step 1 is defining and agreeing on the financial objectives and goals. Some people's goals are getting out of debt. Some are saving for their kids' education. Some is business related. Some is buying their first home or a rental property or whatever it might be. So the first step in a financial plan is the planner and advisor with the client or clients actually defining and outlining what those goals and objectives look like. The second step in the planning process is actually gathering the financial and personal information. Very, very important step in the process. It's as the saying goes, if somebody gives you a map and they tell you where the end goal is, but you have no idea where you're starting, good luck. So that's the whole idea about why you need to gather the financial and personal information in the second step. Step 3, of course, this is done with the planner and their team independently and separate from the client. The client's not really involved in this part of the process. The team of planners will actually analyze the financial and personal information. Through that, they will actually go back to what the goals of the individual or individuals are and develop that plan. Then they meet back with the client or clients and they actually present that financial plan, which generally speaking is going to be doing some sort of implementation process, putting certain pieces to that plan actually in place, because a financial plan is excellent, but if no action is taken, it's really just a bunch of pieces of paper, right? And then, of course, the fifth step in the financial planning process is to actually implement the plan and review it on, generally speaking, for individuals, families or individuals, it's usually reviewed on an annual basis, or of course, if there's any major life changes. And it is said that we go through a major life change every 5 to 7 years, whether that's the birth, death, bankruptcy, inheritance, lots of different factors. And for those business owners or entrepreneurs, when it comes to financial planning, generally a review is going to happen actually quarterly. Okay, so we can move on to the next slide. So financial planning essentials boils down into sort of 4 different silos: cash flow management, investment management, debt management, and tax management. Starting at the top, when it comes to cash flow management, this is where the planners are going to look at, if it's a business owner, they're going to be looking at the balance sheet, assets and liabilities, and as well too, they're going to be looking at the income statement. And for individuals and families, the income statement is a little bit more pertinent. It's sort of dollars in, dollars out, working on that cash flow management with the ultimate goal to get and build your net worth. What are you and your estate worth? And the word estate is a funny one, because a lot of people think, they think of an estate, they think of a castle with sprawling hills and, oh, I'm too small, I don't have an estate. That's actually a myth that I'd like to bust right now. Is when you were born and you are designated a social insurance number, that is the moment that you become your estate. So every single one of us on this call, whether we have hundreds of millions of dollars or we're in debt, each and every one of us has our own estate. Okay, so that's what net worth is really tied to, is to the estate. Next is investment management, generally your assets. Of course, for the topic today, a lot of people think of investments, generally speaking, as plant-based stocks, obviously, but it might also be properties, it might be vehicles, it might be jewelry, it might be art, and all the different things that actually make up someone's investment management and ultimately making up their assets. For the topic today of investing, when it comes to investment management, 2 things to note is fees. Fees make up a big deal when it comes to somebody's investment managed portfolio. And when a financial planner and advisor are looking at how to maximize somebody's investments, fees is a big topic of conversation. And then the next one, the real key to success when it comes to compound interest, staying level-headed and having a good investment management strategy, is implementing automation, making it automatic, otherwise known as paying yourself first. Okay, moving on, we have debt management, working on liabilities. When it comes to debt management, there are really 2 strategies that are widely known. One is called the snowball. The other one is called the avalanche. Working from a snowball, that technique is taking a look at what is your smallest amount of debt, smallest amount of money that you owe, paying that off first, and then building that snowball momentum and confidence, and keep paying off the debts higher and higher as you go. Alternatively, the avalanche method is starting on the opposite route, and that is not necessarily looking at what is your largest amount of debt, but what is the debt that has the largest interest rate associated with that debt. So the avalanche would be paying off the highest interest amount and then working your way down from there. Last on the slide, we have tax management, and that's an inevitability. We've all heard it before. There's nuances to it, but we've all heard it before. There are 2 things certain in this life, that is death and taxes. So when it comes to tax management, financial planning, and the conversation today about plant-based investing, we're looking at capital gains. How is that taxed? That's a whole nother conversation, as well as something called probate. It's different in every province. It's a very high tax in British Columbia. Probate is directly tied to what I said earlier, which is your estate. Once again, an estate does not need to be big. It is literally you. You are the estate. So when it comes to cash flow management, investment management, debt management, and tax management, those are really the financial planning essentials that a professional will help walk you through, look through, and help you gain some traction. So moving on to the next slide. Great. So as great as financial planning is, like anything, we don't want to hear only about the good things. We want to hear about the opposite side of the coin. So some limitations of financial planning is an uncertain future. Okay, that can mean a lot of different things to a lot of different people. In my experience and a lot of the experience of my colleagues, uncertain future really comes and boils down to my passion in my background, which is someone's individual health. So uncertain future generally kind of falls into a disability, a disease, or a death. These are very common occurrences. We all think we're invincible. We all think it won't happen to us, but these are the things that actually, really affect the uncertain future. So lack of accuracy in base data. When building a plan, if the data from the beginning is not accurate, the plan's not going to be accurate. And this usually happens as a result of a weak foundational relationship between the planner, the advisor, and the client. So it's really important to make sure in that first step of the process, defining and agreeing on your goals, that you feel like this planner and advisor is somebody that you trust, know, and like, and want to continue to work with for years to come. It's a long process. Rapid changes in environment and policies. Really, this can be boiled down to government regulations and changes, particular as it stands to tax. It happens often, it happens frequent, so it's important to be surrounded by people who have their pulse on what have been the patterns and changes that might be upcoming for your financial plan. Some external factors, natural disasters and war is a common one. It goes without saying, external factors, 2020, nobody saw that coming. That's something that can really affect somebody's financial plan. However, with that being said, if you go into a situation with some external factors without a plan, you're going to be in a much worse spot than if you go into that with a plan, just saying. Time consuming and expensive. That's kind of actually old school. I mean, currently, financial plan can cost you anywhere between $2,000 to around $7,000. But if you know the right advisor and the right team of advisors, they can actually cut down on the time that it takes to build the plan, and that can actually cut down significantly on the cost to the individual or to the business owner. Lastly is a lack of coordination between professionals. This can really disrupt and limit a financial plan. Again, like I said previously, unless you know the right advisor and team of advisors, their role should truly be to quarterback between your mortgage professional, tax professional, legal professional, realtor, and all the different other professionals that one wants to surround themselves with. So if you have somebody who can quarterback those relationships, this lack of coordination really does not become a problem. Okay, I'm going to rifle through this because I think we got a short amount of time. So when it comes to somebody's credit score, the pieces that make up your score, and why is a score important? Purchasing a home, getting a loan, whatever it might be, right? 35% of that makes up your payment history. Do you pay your debt on time or not? Okay. Next is something called a utilization ratio. Think of it like this. If you have a credit card that has a $1,000 maximum, and you take that credit card every single month and rack it up to $1,000, but you still pay it off every month, so your payment history is good, but your utilization ratio is really, really bad. It is said that what you would like to see, what lenders like to see for a utilization ratio, is about 30% to maybe 30 to 40% of your max available. So if you have a credit card of $1,000, truly, for really good credit score, you should only be getting up to about $300 to $400 on that card. That's actually what you're looking for. 15% of your credit score is built up of length. How long have you had credit in place? 10%, the different types of credit. And lastly, 10% of your credit score is made up from inquiries, broken down into what is known as a hard check and a soft check. The 5 C's of credit. There's more to credit than you might think. Capacity, capital, conditions, character, and collateral. Capacity. A lender is going to look at what is this person's capacity to pay back the loan? What is their job? What is their income? Next, they're going to look at their capital. What do they actually have in terms of assets? Next is the conditions. What's the conditions of the loan? What is the term? What are the repayment schedule? What is the amount? Character. What is the character of this individual? Lenders are often actually Googling people and looking at their websites to figure out a little bit more about their character of who they're lending to. Lastly is collateral. It's similar to capital. Sometimes when you get a loan, you actually have to put up collateral against it. Moving on, TFSA, RRSP, different investment options. This is the best way that I can say it. Think of a registered retirement savings plan and a tax-free savings account like two buckets. Starting with the registered retirement savings plan, the money that goes into that bucket is pre-tax money. What happens is, as that money starts to grow, it's growing tax deferred. At a later date, when you are going to take that out around retirement age of 71, a little bit later, you are going to be taxed on that withdrawal at your marginal tax rate at that time. A tax-free savings account, the money that goes in is after tax dollars. The growth is tax-free, and when you choose to take the money out, that is also tax-free. In between those buckets, a tax-free savings account and a registered retirement savings plan, in and of themselves, they're not really anything. They're just a shell. And what goes inside those different buckets can be cash, guaranteed income certificates, stocks, bonds, mutual funds, treasury bills, exchange traded funds, real estate investment trusts, lots of different options. Those options are what your investments are. A TFSA and an RRSP is not necessarily an investment. It is the vehicle, and the investments are what go inside the vehicle. I know I'm short for time, but a couple of other considerations here. Dollar cost averaging, that is known as a PAC, or a pre-authorized contribution, setting up an investing strategy where every single month, $100 goes into your investments, whatever you choose to invest in. Some months you're going to buy the stock a little high, sometimes it's going to be a little bit low, and it's going to average out and be better for you, versus a lump sum investment. There's nothing wrong with it, but what happens is fear paralyzes a lot of people when they have a lot of cash and they're thinking of, I got to buy it when it's the right time. I got to buy it on the dip. I got to make sure I don't lose any money. And that fear of lump sum investing can actually paralyze people from actually investing altogether. Diversification is very, very important. Think of two elevators. One elevator has one cable attached. The other elevator has 7 cables attached. If either one of those elevators, one of those investments plummeted to 0 and the cable got cut, one elevator would fall to the bottom and the other one would be standing still. So diversification, otherwise known as don't put all your eggs in one basket. Moving on, other considerations, although this is called other considerations, this is actually, I would say, the main consideration. I'm going to fly through this. This is what is known as the financial planning pyramid. The base is your will, power of attorney, representation agreement, and your insurance. These are the uncontrollable factors that are very important to build off first. Next, we have our debt reduction, and as well building out what is known as an emergency fund, slush fund, money under the mattress fund. Okay. On top of that, we have our registered plans, tax-free savings account, registered retirement savings plan, registered education savings plan, registered disability savings plan. Then we have non-registered investments, maybe investing in a business, maybe doing some day trading in a different non-registered account. And lastly, the piece de resistance is actually earning passive income from your investments, and also, believe it or not, from some insurances if you do it properly. This is a way to properly build a financial plan. Unfortunately, in today's world, with this wild market we're in, many people are building their plan as such. Okay, we want to build it properly with a solid foundation. There's a lot of other information. I'm way over time, Henry. Out of respect for everybody here, I'm going to cut it short. Off to you.
Perfect. Thanks so much, Justin. Wow, I for one really appreciate the visual. That's well done. I'm familiar with the concept, but seeing a visual really inks into my brain. So thank you so much for that.